डॉक्टर बाबासाहेब आंबेडकर ओपन युनिव्हर्सिटी.
Welcome to Dr. Babasaheb Ambedkar Open University video lecture series for the subject of Basics of Accounting. Friends, today we are going to discuss Block 3 Unit 1 Capital and Revenue Transactions. Friends, in the definition of accounting, it was said that accounting is an art of recording, classifying and summarizing in terms of money transactions and events of financial character and interpreting the results thereof. Friends, recording, classifying and summarizing. So, recording and classifying, these two words are very important. Before recording expenditure and income, we have to classify whether it is a capital nature or revenue nature of income or expenditure. So, today in this block unit 1, we are going to learn the need for classification of accounts as a capital and revenue, the meaning of capital and revenue expenditure, which is very important in business, the deferred revenue expenditure, the difference between capital revenue and deferred revenue expenditure, the meaning of capital and revenue receipt, the meaning of capital and revenue loss and profits. So, friends, these are the learning objective for today's unit. Now, we are talking about the basics of capital and revenue transactions. The concept of capital and revenue are of fundamental importance to the correct determination of accounting profit for a period and recognitions of a business assets at the end of the period. Friends, what is the main intention of preparing accounts or final accounts? To know the financial position at the end of the year. If we can correctly bifurcate the difference between capital and revenue expenditure or capital and revenue income, then at the end of the year we can get the correct financial position of the business, correct profit or loss of financial activities. Generally, we have two types of transaction. One is a capital transaction and the other is a revenue transaction. Friends, in capital transactions, generally which are the capital transactions? So, in our accounting parlance, the transactions which provide benefits or supply services to the business unit for more than 1 year, this 1 year is important, or one operating cycle of the business are known as capital transactions. So, it is clearly defined, then when you are going to get the benefit of that consideration paid as an expenditure for more than 1 year, then it is considered as a capital expenditure. Items listed under capital expenditure are given below: goodwill, freehold land and building, legal charges, lease expenses incurred on machineries, plants, tools, fixtures, etc. The expenses incurred on trademarks, patent, copyright, design, etc. are also for more than 1 year. So, friends, in a capital expenditure or capital nature of transaction means if we purchase any building, we know that the service, whatever the items we have purchased, building, machinery, is more than 1 year or more than one accounting cycle. So, that is why it is called capital expenditure. Friends, if you have observed one thing, generally when you were taught the types of accounts, in a types of account generally we have a personal account, real account and nominal account. So, all those expenditure behind these real accounts are generally capital expenditures. So, generally capital expenditures accounts or items are recorded under assets. In a revenue transaction, of course, if we know the capital transactions, the opposite nature of capital expenditure, capital transactions are revenue transactions. The transactions which provide benefits or supply services to the business unit for only one accounting year are known as capital transactions, right? Are known as revenue transactions, right? Only 1 year or less than 1 year. Items listed under revenue expenditure are given below. Expenditure made on the purchase of assets meant for resale at a profit for being converted into sellable goods. See friends, assets, we know that assets are capital expenditure, but if we have purchased goods, right? So furniture in general is a capital expenditure. For furniture's businessman, furniture is considered as a good, so it may be considered as a revenue expenditure. So sellable goods such as the cost of goods, raw materials and store expenses incurred on maintenance of such assets, for example repairing, even day-to-day recurring expenses such as salaries, rent, rate, taxes, stationery, postage, which are less than 1 year, are considered as a revenue expenditure. Friends, we have learned that capital expenditure or capital transactions are generally recorded in a balance sheet in final accounts, while the revenue nature or revenue expenditure are generally recorded in profit and loss account. So all those expenses, generally salaries, and one salient feature of revenue nature transactions are frequently happening transactions in business. Suppose salary. So salary we pay every month. So during the year we pay more than one time. Rent, taxes in the same manner. So if it is frequently happening transactions, then it is called revenue transactions, revenue expenditure. So all those expenses, generally rent, rate, taxes, stationery, postage, are written on debit side of profit and loss account. So those transactions which are recorded on debit side of profit and loss accounts are commonly known as revenue transactions. Now friends, the very important concept in accounting is deferred revenue transaction. See, deferred revenue transaction or deferred revenue expenditure means it is a part of revenue expenditure, but generally it is falls in capital as well as revenue types of expenditure transactions. In deferred revenue expenditure, friends, when a large sum of revenue expenditure is incurred in any particular year, the benefit of such expenditure may carry on to several years. Such expenditure is called as deferred revenue expenditure. Friends, this is very important. Generally, amount is payable or paid in a particular year, but the benefits we get more than 1 year is called deferred revenue expenditure. The utilized portion of expenditure is charged to profit and loss account, and balance is carried forward and are written off in future accounting periods, shown in the asset side of balance sheet of the current year. Friends, the wonderful example of deferred revenue expenditure is advertisement, right? Generally, advertisement, if we have paid on a large scale, suppose if we have a contract with any celebrity and we have a contract of 5 years, if we paid 5 crore rupees for 5 years, but we have paid this year only, but the benefits we will get more than 1 year, up to 5 years. So generally, the accounting treatment of deferred revenue expenditure is very important. In advertisement suspense account, we have written here the utilized portion of expenditure is charged to profit and loss account. Means friends, suppose if we have a profit and loss account and if we have a balance sheet, so generally if I have paid suppose 5 crores rupees, so under balance sheet, under miscellaneous expenditure, I will write advertisement expense or advertisement suspense account as a 5 crore rupees, but the benefit I will get for 5 years. So every year I have to write off 1 crore. So ultimately 4 crores will be written outer column, and the utilized amount 1 crore would be written on debit side of P&L account to advertisement expense account, right? So friends, this is a wonderful example, advertisement suspense account. Some of the very famous deferred revenue expenditure accounts are discount on shares, discount on debentures, underwriting commission, advertisement suspense account, and if we have any profit and loss account debit balance, that is also considered as a miscellaneous expense. But under miscellaneous expense, these 4 items, advertisement suspense account, discount on shares, at the time of issue of shares, when we give discount, we know that generally it is for more than 1 year. The same thing happen in debenture also. In debenture, if it is more than 1 year, generally the redemption of debenture is more than 1 year, 5 years, 10 years. So whatever discount given at the time of issue of debenture would be written off for given 5 years. So friends, in discount on debenture, suppose if it is a 5 lakh would be written here, and if we redeem debenture for after 5 years, every year we have to write off it at rupees 1 lakh. So remaining 4 lakh would be written under balance sheet. So friends, these are the basic example of deferred revenue expenditure. In a balance sheet, this is little bit different or differ from revenue expenditure. The main characteristics of deferred revenue expenditure, what we have discussed, such expenses are of revenue nature, means you have to pay that 5 crores immediately this year to the celebrity for 5 years advertisement suspense account. But these expenses are relatively of very large amount. As I said, that suppose discount on issue of shares, discount on issue of debentures, so it is quite big amount. The benefit of such expenses is extended beyond the accounting year or several accounting years. So if discount are given, if advertisement expenses are paid for more than 1 year, we know that we will get more than 1 accounting year, several accounting years. So these are the salient features. In a deferred revenue expenditure, the deferred revenue expenditure comprises of expenditures only paid in advance, the expenses which are usually paid in advance in full during the accounting year. Expenditure partly paid in advance, the expenses which is payable partly for the current year and partly for the next year. Abnormal losses, the amount is written off and is charged to profit and loss account and balance is shown to asset side of the balance sheet. As I said that if we have a debit balance of P&L account or in a loss occurred in a quite large amount, then it would be written under assets. So friends, these are the basic things regarding deferred revenue expenditure. The very important thing is, friend, in accountancy, if you can understand the basic difference between capital expenditure and revenue expenditure, then your recording and classifying will become very easy. And ultimately, if your recording, classifying and summarizing become easy, it is easy to prepare trial balance, it is easy to prepare final accounts. At the end of the year, it is easy to ascertain profit or loss of particular accounting period. So friends, the very important thing is difference between capital expenditure and revenue expenditure. So we have a certain points of difference. One is incurred on acquisition, extension, modification of fixed assets. So friends, acquisition means purchase. In a very first chapter, when we have learned the various concepts, in a cost concept we have learned that acquisition cost we consider. When we purchase any assets, the installation charges or acquisition cost charges would be a part of that cost. So that's why acquisition means purchase of assets, extension if we have an expansion of any machinery or plant, modification on a large scale if we have a modification, or if we on a fixed assets, right, renovation on a fixed asset may be considered as a capital expenditure. Friends, in a revenue expenditure, day-to-day activities of a business. Day-to-day activities means, that's why these are operating expenditure, operating expenses generally written on debit side of profit and loss account. And we have given some example also. Here purchase of machinery, purchase of assets, purchase of land and building, purchase of plant, all these are example of capital expenditure. But friends, in a revenue expenditure, day to day activities means either salary, rent, taxes, some of the postage, stationery and other miscellaneous expenditure are considered as a revenue expenditure. Effect on earning capacity. This expenditure increases the earning capacity of the business. Friends, generally capital expenditure, any expenditure should have a adverse effect on the profit. But wait, if it is a capital expenditure for acquisition or purchase of an asset, it will increase the efficiency of a business. So, if it will increase the efficiency of a business, friends, the earning will automatically be increased. While under revenue expenditure, this expenditure maintain the earning capacity of business. Expenses on regular maintenance would help to avoid stoppage in performance. Friends, generally this expenditure, revenue type of expenditure are maintenance expenses in general. For day to day transactions, one need to do all these expenses, because without this type of expenses we cannot manage or manage our operating activities. Friends, not recognized on the basis of amounts spent. Expenditure is not in capital nature as quite huge amount is involved. Friends, we know that if it is a quite huge amount, when we purchase goods, that is a revenue expenditure, but when we purchase land and building, machinery, such huge amount is involved, then it is a capital expenditure. Friends, expenditure is not revenue in nature only as the amount involved is small, right? So, generally it does not mean that only small amount is payable or paid, then it should be revenue expenditure. It is not all time correct. Add value to existing asset. Friends, this type of expenditure adds value to an existing asset when modification, extension to existing asset is done. As I said that if we have a expansion, suppose we have a building, so if we want to take another expansion as a part of that building, so that expansion activity is considered as a capital expenditure. Friends, generally in a renovation case, in case of plant, in case of computer, if we are going to replace the technology and if it is a quite big amount, right, then it is considered as a capital expenditure. While under revenue expenditure, this type of expenditure does not add any value to an existing assets. Friends, these are operating expenditure, means when we pay salary, when we pay rent, we pay taxes. So, it will not add value to the assets, but these are for day to day transactions. With the help of this expenditure, day to day activities of business can be done properly. Add value to existing assets. As I said that this type of expenditure add value. Benefits derived. Benefits more than one accounting period or several periods. Friends, very logical also, when we purchase any assets, either it is land and building, plant and machinery, furnitures or fixtures, the usage is for more than 1 year or rather several years. So, capital expenditure is always benefits more than one accounting period. While under revenue, normally benefits is for one accounting period. Salary or rent, taxes, if we pay, it is for one accounting period. Next accounting period, again we have to pay the taxes, we have to pay the salary, we have to pay the rent, we have to pay other stationery expenses. So, frequently happening expenditure, frequently happening events means revenue expenditure, we can say. Were recorded in balance sheet subject to depreciation. Friends, this is very important. See, the accounting treatment of capital expenditure is, if we have purchased any machinery, the cost of machinery is 1 lakh and the useful life of machinery is 10 years. So, then generally the treatment is in a balance sheet. Suppose if this is a balance sheet, in balance sheet under assets, this is liability. Under assets we write machinery amount is 1 lakh minus, as I said, the life is 10 years, right. So, every year we can write off 10,000. So, 10,000 will be deducted and net value of machinery 90,000 would be written outer column under asset. Later on we are going to learn final accounts of business, where I am going to discuss, or I am going to teach in detail what would be the accounting treatment for various capital expenditure. But then the remaining 10,000 which is subject to depreciation or written off as a depreciation would be written on debit side of profit and loss account. So, friends, ultimately 90,000 would be written outer column, while 10,000 remaining would be written on debit side of P&L account. So, friends, these are the very basic difference between capital expenditure and revenue expenditure. Friends, the very important is capital expenditure and deferred revenue expenditure. See, the logic is, if the benefit is for more than 1 year, it should be capital expenditure. But wait, in revenue expense also, if the benefit we are going to get more than 1 year, then it would be treated as a deferred revenue expenditure. So, friends, there is a wafer thin line between capital expenditure and deferred revenue expenditure. Let us discuss it. Under capital expenditure, acquisition, extension, modification, what I have just explained, but under deferred revenue expenditure, an item the benefits of which would be derived for 2 to 5 years in near future. As I said, if I have paid advertisement expense for 5 years, right, if I will get benefit for 5 years, I have paid this year, payable this year, but benefits will be for next 5 years. This expenditure increase the earning capacity of business, but wait, no effect on earning capacity, but some of this expenditure may help in maintaining the capacity as like revenue expenditure. Friends, ultimately, if you do advertisement expense, the effect would be on your earning capacity also. Expenditure is not in capital nature as quite huge amount is involved, right. If quite huge amount is not involved, it should not be capital expenditure in general, what we believe. Recognitions is also based on the amount spent. Generally, friend, amount may be huge or small, but the benefit would be for more than 2 to 5 years, right. That is very important. Under capital expenditure, this type of expenditure adds value to an existing asset when modification, extension to existing asset is done, while does not add value to an existing assets. So, friends, generally advertisement expense, discount on shares, discount on debentures, underwriting commission, so all these are expenditure, but to the extent not written off, that is why we are writing it under asset. So, this is not real assets like machinery, plant, furniture, land and building, and that is why sometime it is written under miscellaneous expense or fictitious asset. Fictitious assets means this is not real asset, these are the expenditure to the extent not written off. This generally definition we use. Under capital expenditure, benefits more than one accounting period or for several periods that we have just discussed, while under revenue, deferred revenue expenditure, benefits may be derived for more than one accounting period, but for near future, right. See, if we have purchased any machinery or purchased any land and building, we can use for several years, but if we pay advertisement suspense account, right, then it is for 5 years maximum, 2 years, 3 years, 5 years, right. It is not for several years, and it is, see, used for near future, right. Recorded in balance sheet subject to depreciation. I have just in the last slide we have discussed that what would be the accounting treatment when we have purchased plant and machinery, right. So, we have to deduct a depreciation, ultimately net amount would be written outer side, outer column. Under deferred revenue expenditure also we have learned the treatment. The part of the amount to be written off during current period is recorded in income statement, means debit side of profit and loss account, while the rest of the amount which is not written off, to the extent not written off, amount should be written under assets, right. as a fictitious asset or as a miscellaneous expenditure. Friends, it is a different issue that in the new revised schedule 3 it does not recognize any title like deferred revenue expenditure, but that is a different issue. For us, what would be the accounting treatment for sole proprietor, that is in our syllabus. Now friends, capital receipt. See, a receipt is the inflow of money into the business which indicates the money received by a business enterprise. A receipt of money is considered as a capital receipt when a contribution is made by the proprietor, partners or shareholders towards the capital of business, or a contribution of capital by someone outside the business. Capital receipts create a liability for the business, for example, when a loan or mortgage on a property is arranged. Friends, capital receipt means when we take loan, we issue debentures, that is a capital receipt would be written under liability. In the same manner, revenue receipt means a receipt of money is considered as a revenue receipt when it is received from customers for goods supplied or fees received for services rendered in the ordinary course of business, which is a result of the firm's activity in the current period, right. So, sale of goods, and if we get any consulting fee, that is of course considered as a revenue receipt. Revenue receipt increase the profit and reduce the loss of the firm. For example, discount received, commission received, interest received, rent received, all these items are recorded on credit side of profit and loss account. Capital and revenue profits. Capital profit is the profit gained due to sale of fixed asset. For example, building purchased 220, sold for 3,25,000, difference is considered as a capital profit. Revenue profit means profit is a profit made by its normal business activity. For example, profit made through sale of goods, income from investment, etc. That is why it is recorded in profit and loss account, friends. Capital profit should be transferred to capital account and liability side of balance sheet. Revenue profit is entered in P&L account that we have just discussed, right. Friends, in this block 3 unit 1, we have discussed the variety of revenue and capital transactions, right. Mainly what is capital expenditure, capital receipt, revenue expenditure and revenue receipts. These are some example. Generally we take rupees 20,000 is the expense incurred for remodeling the factory, right. So, enhancement value is 15,000. So, if it enhance something, it is considered as a capital expenditure. All these examples are very simple, very easy, but given in your material also for your study, various reference book for your study. So, I advise you to go through with all the transactions. And friends, in this unit, block 3 unit 1, we have discussed about the capital and revenue transactions. Friends, either capital transaction means more than 1 year, keep this thing in your mind, and revenue transactions means less than 1 year, while deferred revenue expenditure is an expenditure paid in 1 year, but benefits are given for more than 1 year, several years are considered as a deferred revenue expenditure. In this block unit 1, we have learnt the accounting treatment for capital expenditure, capital receipts, revenue expenditure, revenue receipt, and very important concept, that is deferred revenue expenditure. So, friends, I hope you will learn all these things in detail with some of your reference material also. Thank you very much. Swadhyaya